A recovery in the labor and employment markets still remains incomplete, and wage rates have remained depressed, and another round of pandemic could derail any sense of economic recovery. Though there are signs of nascent revival in private investment activity and public investment remains robust, any uncertainty driven by the spread of the Omicron variant of coronavirus could derail that too. Let's go to ICRA Chief Economist Aditi Nair to understand what the biggest worries for the Finance Minister are as she prepares her budget.
What will worry the Finance Minister the most about the FY23 budget? In my view, uncertainty. We've had two consecutive budgets that have been blindsided by COVID already. In FY21, a revenue crash in the first half of the year with higher welfare expenditure ended up doubling the fiscal deficit in absolute terms. And in FY22, even though we are expecting revenue receipts to be well above the budgeted level, a higher expenditure and a sharp shortfall in disinvestment receipts are sure to result in the fiscal deficit overshooting the budgeted target of 15.1 trillion. We foresee the FY22 fiscal deficit at closer to 16.5 to 17 trillion. So that's quite a bit above the budgeted level. Next year is an interesting picture. On the one hand, we do believe that direct taxes are going to grow quite well, but there will be the overhang of the excise and customs duty relief that was given in late 2021. And that's going to bring down the rate of growth very sharply in FY23 for these tax revenues. And also the tailwind of higher commodity prices that had pushed up the customs duty collections, that is going to be much weaker in FY23. So we do think that tax revenues are unlikely to expand as much as nominal GDP growth in FY23. The national monetization pipeline could bring in some modest receipts, and there's a high likelihood that the spillover of disinvestment flows from FY22 will materialize in FY23, particularly for LIC, and that should net a substantial amount of capital receipts for Government of India. Against this revenue backdrop, we think that capital expenditure could be realistically budgeted at around 5.5 to 6 trillion. The PLI schemes will also need to be provided with adequate outlays. However, what is the level of food subsidy and NREGA that is appropriate to budget for FY23 when we really don't know what new variants of COVID lurk ahead? Such spending will determine where the Government of India's revenue expenditure and therefore fiscal deficit and the borrowing program for FY23 settle. And this uncertainty is what I believe will worry the Finance Minister the most.
The World Bank and Moody's have projected the Indian economy to grow at 8.3% and 9.3% respectively. The Reserve Bank of India has retained its projection of 9.5% annual GDP growth for FY22, although it has lowered its December quarter growth estimate to 6.6% from 6.8% and March quarter growth estimate to 6% from 6.1%. The Indian economy expanded 8.4% in the September quarter, surpassing the pre-pandemic level as vaccination picked up pace and services activity returned to normal after the disruptions caused by the devastating second wave of the pandemic in the June quarter. The budget also comes at a time when economic recovery is seen as more K-shaped than V-shaped. A Pew Research Center report last year said that the coronavirus pandemic may have shrunk India's middle-class population by 32 million and driven 75 million below the poverty line in 2020 as a severe recession walloped India's third largest economy. India plunged into its deepest recession in more than 40 years as the pandemic led to massive job losses. Many experts believe the pandemic could have partly reversed India's earlier success of substantially reducing poverty, but the shrinking of its middle-class population, which drives consumption in the country, could have medium-term impact on growth trajectory. The International Monetary Fund has also pared India's potential growth by 25 basis points to 6% due to the impact of the pandemic. Let's go to Madan Sapnavis for his views on the likely focus of the budget.
By the time the budget is presented, you have to keep in mind two things. One is that on the expenditure side, you may have to spend more in terms of providing relief to the poorer segments of society. There has to be greater expenditure on healthcare. We're already talking of a booster shot being provided to the majority, which means that there will have to be certain outlays coming from the center too. On the other hand, on the revenue side, with certain curbs already being placed in the last week of December, it does look like that the services sector, which seemed to be getting up on its feet, is once again going to feel constrained. And that could have ramifications in terms of revenue collections during the course of the next fiscal year. So keeping these two things in mind and the fact that the government is committed towards getting this fiscal discipline in place, which means moving towards the target of 3% of fiscal deficit, I think there's very little elbow room for the government.
With the government withdrawing the 3 farm laws after year-long protest by farmers along Delhi's borders, it will also be keenly watched what the budget has to offer for the farm sector. This is particularly crucial in view of the upcoming assembly elections in Punjab, Uttar Pradesh, Uttarakhand, Manipur and Goa. The farmers' unrest is seen to have political implications for the incumbent BJP government in UP. In Punjab too, BJP would like to improve its performance with a fresh alliance with Captain Amrinder Singh's Punjab Lok Congress. In such a scenario, it would like to keep the farming community happy. Will there be a farm package in the budget? Can there be a hike in PM Kisan benefits for the present, from the present 6,000 rupees? Let's wait and watch.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.